Thank you for joining me today. My name is Carissa Dorado, and we're going to be reviewing the Home Buyer's Mortgage Guide. My mission is to provide a hassle-free mortgage experience, and today we're going to be talking about strategies and knowledge that will allow for a smooth transition into home ownership through understanding the process and tips for smooth transition. A little about me. I'm a mortgage loan officer with MB Financial out of the Orchard Park, New York office. I work just a few hours a week as a credit counselor at a local non-for-profit agency. I work with credit reports, student loans, and foreclosures, and also a landlord. When I'm not working, I do enjoy spending time with family and friends, snowboarding, kayaking, fishing, and biking. A little about MB Financial. We offer USDA, FHA, VA, and conventional loans. Also have additional financing through my community mortgage loans. I am able to work with credit scores as low as 600. I have competitive rates, and I have no application fees, meaning you can start the process with me for free. Services. My clients will work with me directly through the process, and I also have 2 local full-time processors to assist once a house has been located. I am available 7 days a week via phone and text message. MB services its own loans. We were established in 1911, and we are a federally chartered bank that can lend in 44 states. Buying a home, the American dream. Before the 1930s, houses were only purchased with cash. 40% of American families owned homes, and then came mortgages, a loan in which the house functions as collateral. Table of contents. So today we're going to be talking about getting started, getting approved, credit, mortgage options, mortgage payments, mortgage insurance, seller's concession, funds to close, closing, tips, and lastly, required documents. So getting started. So you're thinking about buying a home. Before you get started in your search, it's important to have all your financial ducks in a row. Talking with a loan officer is the first step in the home buying process. I would recommend talking with me at least 3 to 6 months before you start looking for houses. This will help us identify and correct any potential problems, such as too much debt, a low credit score, credit disputes. It'll also give you some time to locate some important documents such as W-2s, tax returns, divorce decrees, child support orders, and so on. When it is time to start looking for houses, you'll need to get pre-approved. And why to get pre-approved? Real estate agents will be more willing to work with you. Sellers will take your offer seriously, and it'll help narrow your price range. There may be a difference between what you can afford and what you qualify for. Getting approved. We're going to be looking at credit worthiness, income and employment history, and money for closing. With credit worthiness, your credit score serves as a risk assessment for lenders on how likely you are to repay your loan. The higher your credit score, the lower the risk of default. For income and employment history, we'll be looking at 2, possibly 3 years of federal tax returns and W-2s, and also 30 days most recent pay stubs. And money for down payment and closing, and we'll also be looking at verifying assets and deposits going into bank accounts. Credit. Your credit score is calculated by the 3 national credit reporting bureaus, TransUnion, Experian, and Equifax. Lenders use your medium credit score. For example, if your credit scores are 702, 736, and 726, we will use 726 for mortgage purposes. Check your credit report and credit score. When you review your credit report, the inquiry is considered a soft hit and does not lower your credit score. We ask that you continue to review your credit report during this process. You can do it through Credit Karma. Credit Karma gives you free access to your Equifax and TransUnion credit report and score. And annualcreditreport.com is set up through the government, and you can review all 3 credit reports once every 12 months. You do not receive your credit score for free. Factors that make up your credit score. 35% is payment history. 30% is outstanding debt compared to your credit limit. 15% is length of credit history. 10% new credit. 10% types of credit. Payment history, 35%. Raise score by paying your credit reported accounts on time every single month, having a long history of paying accounts on time, and if you've had late payments or delinquency in the past, the longer it's been since that event, the higher your credit score. You will want to make sure that you have accounts that do show up on your credit report. Lower scores are caused by making late payments. One 30-day late payment can significantly lower your credit score, as shown by the example below. A 30-day late payment for somebody with a credit score of 680 could potentially drop their score between 60 to 80 points. For somebody who had a credit score of 780, one 30-day late payment could knock their score down 90 to 110 points. 90-day late collection, judgments, and/or bankruptcies can significantly lower your credit score for years. Here's an example of a FICO credit score and 3 different customers with different credit scores. You can see within the example how different events will affect the credit score differently based off from the event and the starting credit score. Outstanding debt, 30%. Raise score by having a low credit limit to balance ratio, also known as your utilization ratio. Try for a 30% or lower utilization ratio per card. For an example, a $1,000 credit limit, you'll want the balance to not go over $300. The credit card companies can report your account balance at any time during the month. Lower scores are caused by maxing out or using most of your available credit, and when a lender lowers your credit limit. Length of credit history, 15%. Raise score by, ideally you want to keep your long-standing accounts open and active. Keeping long-standing accounts open even with a zero balance. It is better to let a lender close an account for inactivity than for you to actively close an account. Lower scores are caused by actively closing accounts, especially accounts that have been open for more than 10 years. New credit, 10%. Raise the score by not allowing credit inquiries unless absolutely necessary and trying for less than 3 inquiries into your credit report per year. Other factors, mortgage and auto rate shopping done within a 14-day period will only count as 1 credit inquiry. You can look at your credit report and score as often as you would like, as it's considered a soft hit. Lower scores caused by too many hard inquiries. Each inquiry could decrease your credit score by 10 points or more. And open several accounts in a short period of time represents a greater risk. Types of credit, 10%. Raise credit score by striving for a mix of credit. This would be installment loans and revolving. Installment loans are mortgages, auto loan, and personal loans, and revolving is credit card. Having no more than 3 credit cards total, including store cards. Lower scores are caused by too many open accounts with balances, using only one type of credit, such as only having revolving credit card accounts open. What your FICO credit score means. This shows you what the difference in credit score means for you. So if you have a credit score between 750 and 850, excellent. Between 700 and 749, good. 650 to 699, fair. And 300 to 649 is considered poor. Mortgage payments. We're going to start off by reviewing mortgage options. Conventional, 3 to 5% minimum down payment. Fixed rate mortgage we offer a 15, 20, and 30-year term. The 30-year fixed rate mortgage is the most common. Also, an adjustable rate mortgage. ARM loans offer a low introductory rate for an initial period, usually 5 to 7 years. And the My Community Mortgage Program is a conventional loan product offered by Fannie Mae for borrowers who meet specific criteria, usually low to moderate income, and up to a 4-unit property. This is nice for an owner-occupied 4-unit property who might be able to do just a 5% down payment program. Government-backed loans, we have 0 to 3.5% minimum down programs. FHA, or the Federal Housing Administration, has a 3.5% down payment, and FHA offers the most flexible eligibility requirements. USDA is a 0% down program. It does have income and location eligibility requirements. And VA for eligible U.S. veterans is also a 0% down program. And VA loans are available to past and present military personnel. Mortgage payment. A mortgage payment is made up of many parts. PITI. P, principal, amount of money you borrowed. I, interest, cost of borrowing the money. T, taxes, property taxes. I, insurance, homeowners insurance and mortgage insurance, and association dues. Escrow. For most homeowners, taxes and homeowners insurance are paid into an escrow account. Escrow is a financial instrument created in order to store money collected by a lender. When taxes and insurance are due, the lender pays for them for you from your escrow account. This amount can fluctuate over the life of the loan, even with a fixed rate mortgage. Other things that you will need to consider is homeowner association dues, an amount paid monthly by owners of certain types of residential properties to an organization that assists in maintaining and improving that property. Term. The length of your mortgage. The shorter the loan term, usually the higher the principal amount, payment amount. Mortgage insurance. Mortgage insurance protects the lender against loss if a borrower defaults on a loan. Mortgage insurance is paid by the borrower, but it benefits the lender. Mortgage insurance is required on conventional mortgages with less than 20% down. Private mortgage insurance, or PMI, will drop after the borrower pays down the mortgage to 80% of the original value. If the value of the house increases before the 80% of the original value is obtained, an appraisal can be used to see if PMI can be dropped. Other restrictions do apply. FHA and USDA mortgages, borrowers must pay mortgage insurance premium, MIP, for the life of the loan. There are two types of MIP, upfront MIP and monthly MIP. Upfront MIP is added to the loan balance. And this is some examples for you based off from the different loan programs. On the left we have FHA, middle USDA, and at the end conventional. This all shows you an example of a $100,000 purchase price. To start off with FHA, it has the 3.5% down payment minimum, making the loan amount $96,500. FHA has the upfront mortgage insurance premium of $1.75, which is equivalent to $1,688. That amount gets added to the loan balance and it is factored into the principal interest payment. It also has a monthly MIP of 0.85% that also gets factored into the mortgage payment. For this example, it's $70. USDA has a 0% down, and the mortgage insurance, or the U.S. guarantee rate, is 2.75%. For this example, is $2,750. That is added to the loan amount here and factored into the principal interest payment. It also has a monthly MI rate of 0.5%, which is factored into the mortgage payment down here of $43. The last example is conventional. With a 5% minimum down payment, it does not have any upfront mortgage insurance premiums, but it does have a PMI rate. The PMI is based off from the credit score and the down payment. For this example, I used 0.62, and that's factored into the monthly payment of $49. Seller's concession. Seller's concession is a set dollar amount or percentage of the purchase price that a seller agrees to add to the purchase price, and then that amount goes towards your closing costs. This will help lower the amount of money you are required to bring to closing. FHA example. Net to seller is $100,000 and 5% seller's concession, $5,000, is added to the purchase price. The sales contract would state the purchase price at $105,000 and the seller's concession at $5,000. That $5,000 would then come off the closing costs. An example of a sales contract that includes seller's concession below. Funds to close. During the mortgage process, you are going to be asked to provide 60 days worth of bank statements. This will show you have the money for your contract deposit, otherwise known as your earnest money deposit, and if needed, money for closing and down payment. Typical sources of funds for closing: checking and savings accounts. Cash deposits will most likely not be counted towards your down payment and closing cost money. No cash can be going into your bank account during these times. Let me know if this is going to be a problem. A gift from family member. Also want to let me know if this is going to be coming up so we can properly prepare. Withdrawal or borrow from your 401k or retirement account. Current assets such as stocks and bonds. Trust accounts and cash value of life insurance policies. Closing. Cost to close includes down payment, origination fees, bank fees, and prepaids. Prepaids are expenses you pay at closing before they are technically due. They are necessary to create an escrow account. Prepaids can include property taxes, homeowners insurance, and mortgage insurance. Out-of-pocket costs while purchasing a home. The first is going to be your earnest money deposit or your contract deposit. This is money intended to entice the seller into accepting your offer, also referred to as a good faith money deposit. It is considered part of your down payment at closing. A larger earnest money deposit can make your offer stronger. You will be asked to provide bank statements showing your earnest money deposit being withdrawn from your account and a copy of the canceled check proving the check was cashed. A personal check is the only recommended payment method. Your home inspection. It is optional but recommended, and costs do vary quite a bit. The next is your appraisal, and that's going to be due about a week or a little less after we sit down and go through your mortgage disclosures. We will email you a link to pay for it right online by debit or credit. Insurance binder. It's 1 year's worth of homeowner's insurance about 2 weeks before closing, paid directly to the homeowner's insurance company. And at closing, this will be your cash to close, your down payment, origination fee, and closing fee, and we would subtract out your earnest money deposit. You'll want to ask your attorney about the best way to pay for these fees and the name of the recipient. And the last is your attorney. Tips. Credit. Do not originate any credit inquiries onto your credit report. This can lower your credit score. Do not obtain new credit. Your approval was based off from your income and monthly obligations. Obtaining new credit will not only impact your debt to income ratio, but also your credit profile as well. This includes new accounts, auto loans, boat loans, furniture, or new purchases on existing accounts, vacation, furniture, essentially just making sure the balance on the credit card doesn't go up a lot, or a co-signing for somebody. Do not make changes to your current credit. You can reduce your credit score by reducing your credit limit, closing an account, paying off old delinquent collections. These accounts can bubble back up into your recent payment history. If you pay off your credit card debt, we will need to know where the money came from to pay the debt off. Do not use your current credit card debt excessively, and make sure you stay current on your payments. We will monitor your credit report until closing. Make sure your co-signer on any bill or credit is also making the regular monthly payments. You can use Credit Karma, which is free, or a paid service to regularly check your credit report. And remember, you checking your credit report doesn't decrease your score. Employment. Do not change jobs or positions without reviewing with me first. Consistency in job history is taken into consideration when a loan is approved. Income compensation changes can impact your approval. For example, going from a salary position to commission can change your approval amount. Bank accounts. Do not deposit cash into your bank accounts. Cash is not an acceptable source of money for closing. Do not overdraft or fall behind on your bills. Make sure you don't overdraft on any account. Your bank statement will normally show your overdraft year to date. Do not lose track of deposits. Adding to your assets isn't a problem, but you have to provide a complete documentation of any deposits other than your usual paycheck. Make sure you document everything. Putting in an offer. Forgetting seller's concession. Make sure your realtor knows you want to have seller's concession added to your offer. Earnest money deposit or contract deposit. Make sure you write your personal check from an account that you wish to provide 60 days worth of bank statements for. A personal check is the only recommended payment option. 11. Required documentation. Income. Depending on the different types of income sources that we're including on your mortgage application, we're going to need to provide documentation. So if you work for an employer, we're going to need the most recent 30-day pay stubs showing your year-to-date earnings. You'll need to continue to save your pay stubs during the process, as the underwriter might request them. W-2 forms for the last 2 years, possibly 3 years, depending on the time of the year. Last 2-year federal tax returns with all schedules, possibly 3 years again, depending on the time of year. Most recent Social Security or pension award letter, and a copy of a diploma, transcripts, or military discharge. Remember, this just depends on the type of income we included on your mortgage application. Liabilities. Liabilities could include child support order or divorce decreed, and most recent monthly statement for any credit reported account open in the last 6 months. For assets, we'll need 2 most recent copies of a checking and or savings account statements, all pages, even if blank, 2 most recent statements from your 401k, IRA, mutual funds, and or stocks, all pages, even if blank, and an explanation and source of any large deposits made into the above mentioned accounts. The people in the process, your MB financial team. Mortgage loan officer, that would be me. The mortgage loan officer's job is to help you get pre-qualified, determine which mortgage program best suits your needs, and completes the mortgage application with you. The loan officer oversees your loan throughout the process with the help of the loan processor. The loan processor assembles your documentation and sends it to your underwriter. This person will be collecting your additional items needed during the process, such as bank statements, insurance agent information, and so on. The mortgage underwriter. The underwriter is a professional authorized to determine if you are eligible for a mortgage. The underwriter will approve or reject your mortgage loan application based upon your credit history, employment history, assets, debts, and other factors. Real estate agent. Your real estate agent will help you find houses, schedule the viewings, and examine comparable houses. When you're ready to make an offer, your real estate agent will handle the negotiations with the seller's real estate agent. The real estate agents almost always get paid by the seller upon the sale of the home. Real estate appraiser. The appraiser's job is to inspect the property to determine how much it's worth and look for building defects such as cracked foundation or leaky roof. The attorneys. You'll notice there's 3 attorneys listed. We are able to combine the purchaser attorney and the bank attorney, and this would save you a couple dollars. So the attorney roles. Seller attorney. The seller's attorney is responsible for getting the title work updated, search and survey, current tax receipts, order any water, septic, or well testing if needed. Purchaser's attorney. Once the purchaser's attorney receives the title documents, they will order their title exam and title report from the title company. They are in charge of sending title report, survey, and tax receipts to the bank attorney. Once the bank attorney receives everything from the purchaser's attorney, they forward it on to the processor, who will send it to the underwriter for review. Once the file is clear to close, they will schedule the closing with the purchaser and seller attorneys. Thank you for joining me today. I appreciate you taking the time out of your busy schedule to view the presentation. Please be sure to email me your questions or concerns at cdorado@mbmortgage.com. That's cdorado@mbmortgage.com. Thank you and have a great day.